Welcome to the ARMR Report. I'm your host, Brett Rosenthal. This is the ARMR Education Series. Today we're going to cover stop loss rules. We're doing this again for all of you who were here at 4:30. Thanks for bearing with me. I'm going to set it up again. You guys have heard this before, but this is for everyone else. So here we go. What we're going to discuss tonight is the ARMR investing way. There's 3 stages to the ARMR investing way. I'm going to walk you through the first 2, and we're going to focus on the 3rd stage, which is stop loss rules, how to execute them. To set it up real quick again, the ARMR Report stands for Algorithmic Risk Management Research. This is a show about quantamental investing. It's the combination of quantitative execution, which means using algorithms and computers to help us buy and sell things, and combining that with a fundamental foundation, and that's what gives us the information edge that I share with you. All this information I'm going to share is information I use to manage my own capital as well as investors I work with through our Interactive Brokers affiliation. So, whatever we talk about tonight, these are thoughts for you to take and make your own. I'm not telling you what stocks to buy. I don't know you. I couldn't possibly do that. But I am going to share with you chart patterns tonight and step-by-step analysis of how we put stops on and how we execute them. Okay? So let's jump right in. The ARMR investing way. And by the way, if you want to know more about this, you can write down here, subscribe to the ARMR Report, ARMRreport.com. You can also subscribe to this YouTube channel if you haven't already. And in this description down here, I lay out for you the 3 stages of the ARMR investing way. The first stage, fundamental research, and we call it the whiteboard. So you take all of your favorite ideas and you put them on the whiteboard. You don't buy them right away. This is key. You don't buy them just because you love them. The market doesn't care what you like or doesn't like. Okay? So what you do is you build your whiteboard, and you could follow 3 separate, usually most ideas, but for us, the ARMR investing way, we have 3 separate ways to add something to the whiteboard. The first is earnings momentum driven ideas, which are like a William O'Neill style of investing. The second are turnaround plays, which I call value investing, my kind of value, right? I'm finding value that's turning around. And the third is what people would call the Peter Lynch style, companies whose products you use that you like, you start doing research on, and you add them to your whiteboard. Okay? That's stage 1 of the ARMR investing way. Build the whiteboard. Phase 2 is to use quantitative algorithms to help you make the buy and sell decisions. You have got to divorce your emotions from the decision process of managing capital. It's your emotions that get in your way that make it difficult to build net worth in a significant way over time. And so we use algorithms here in-house, the ARMR Report. I've created these algorithms that are specifically designed for the volatility of each index. So we have 3 separate types of algorithms. The first is for the market, right? Algorithms designed for the big indexes. The second is for industry groups. Algorithms designed just for specific industry groups. And the third are algorithms designed to help us buy and sell individual stocks. We execute based on the algorithm, not based on our emotion. That's phase 2. That's execution research. The third phase, and what we're going to talk about tonight, is really what it's all about to me. It all comes together here. If you don't do this correctly, the other 2 don't work. This third part, this third phase, is the risk management research. and it's called stop losses. So grab a pen, piece of paper. You might want to jot some of this down. I'm going to walk you through the steps of the ARMR Investing Way stop loss discipline. I'll give you a minute. Okay. Step 1 is a process that I call principal protection stops. To explain this in a very simple and logical way, let me say this. I will never buy a stock if I don't already know what I'm willing to lose on it. I calculate, using the algorithms, we calculate the entry point that shows us where the reward versus risk equation is optimal. That's our buy point. We put the biggest position size on. This is key. We put the biggest position size on at original entry. We don't average down. We don't pyramid up. That's not the ARMR Investing Way. We say the optimal buy point based on computer algorithms is now. If that's the case, we already know what we're willing to lose, and that's the principal protection stop. Now, the key here is it's not just a basic percentage. You can't just pick out of a hat, oh, if it goes down 3%, I'll sell it. If it goes down 5%, I'll sell it. 10%, I'll sell it. Every stock has a different volatility profile. So a blanket percentage doesn't work. So what we do is we go to the chart and we identify 3 stop points for our principal protection stops. The first is the low of the day we buy the asset. The second is the low of the move we're buying, and I'll show you that on a chart to explain it better. And the third is the low of the structure we're buying, which I'll also show you in a minute. But for step 1, low of the day we bought it, I'm going to share something with you, okay? This is a fact. I've spent hours, I've spent days crunching numbers, writing algorithms, doing optimizations to discover what's the best stop on all different types of strategies. It could be day trading, it could be week-to-week trade, swing trading, long-term investing. It doesn't matter. Every time I run this analysis, the same result pops out. The low of the day I bought it is the best stop. It's crazy, but it's true. And I challenge you to look into your portfolio and look at your best ideas. And go back and look when you bought it. Did the stock ever challenge the low? Or did you buy it and it ripped higher? Your best successes won't challenge the stop. And that's why LODB, low of the day you bought it, works the best. But, so you say, why don't I just use that all the time? Okay. I don't use it all the time because we don't always buy right, do we? We don't always buy the right day. Sometimes we buy it a day or two late. And so then we use the low of the move we're buying. We recognize what the right day was, and we realize we're really 3 days late. So now the stop has to move to the low of the beginning of that move, LOMB, low of the move we bought. And the third stop is the most lenient, it's the most relaxed. We call it low of the structure we're buying. Sometimes if we're buying a stock that pays a fat dividend or a more conservative stock or any of those types of ideas, the structure is a chart pattern that we're looking at. And we see that, let's say it's a double bottom. And we're buying close enough to that structure bottom. And we say, we're going to give this as much room as possible as long as it stays above the low of that double bottom. Maybe we're going to keep collecting the dividends even if it trades like this for a while. And so we don't want to get whipped in and out of it, and we give it a more lenient stop. I also use the low of the structure, LOSB, during times of a ripping bull market, such as right now. Because the simple fact is 7 out of 10 stocks follow the market. So a ripping bull market is going to bail you out of a lot of bad entries if you just give it time. In a bear market, I'll always use the low of the bar I bought, the low of the day I bought, always. Because it's an ugly market and I'm taking my shots, but I'm going to protect my capital quick if I'm wrong. So those are the basic 3 stops for principal protection. Let's go look at a couple charts and I'll show you to you what I mean. This is a chart. I could show you any chart. I'm just going to have, IIPR. This is a fun one. We recently bought this. Okay, IIPR. Okay, we bought it first back here, but recently we paid for it right here on this day. You guys can see this. Let me blow it up some more to make it even easier. Okay? This is the day we bought it. So in this particular case, the stock went above the 200-day moving average. Then they announced a secondary. That was our trigger. We wanted to buy the secondary, so we bought it. So the low of this day is 81.50. Okay? It closed on this day 81 3/4. And then it never looked back and the stock took off. So the 3 stop points would have been LODB, 81.50. Now let me tell you something. This is key. Write this down as a note. This is very important. How to execute the stop rules. This is very important. So please write this down as a note to the side here. We never stop ourselves out in the first 2 hours of trading. I know that sounds crazy, but again, I'm sharing with you optimized information from algorithmic studies that I've done. The first 2 hours a day are generally the time that the high frequency trading algos are out hunting. That's when they hunt. The first 2 hours of the day. And they're hunting for your stop. How many times has it happened to you that the stock goes down between 9:30 and 11:30, takes you out of your position, turns around and rips higher the rest of the day? It's not a coincidence. It doesn't just happen to you. It's happened to all of us. It's because there's high frequency trading algos and all they do is stop hunt. How do they know your stop's there? Because people put stop losses in. And just because you've come up with a stop price you think makes sense, hey man, it's a big world. Don't think you're the only one that thinks that's the right stop point. In fact, if you're good at what you do, you've identified the right stop and everybody's there. So the HFTs hunt you in the morning. They try to drive the price down below that stop to wipe out everybody, collect your stock before it rips higher. So you say to me, well, Brett, geez, if it goes through your stop at 9:30, 10 o'clock, you could be down huge by the end of the day if you wait. Yes, I can. Guilty as charged. It could happen. It does happen. Sometimes it happens. Statistically speaking, it happens a small percentage of the time. And I'm willing to accept that for the large percentage of the time where I will stay in my position through the stop hunt and end up making money on that asset, particularly in a bull market. In a bear market, maybe we're going to be a little bit quicker on our stops, but not in a market that's a bull market, which is, let's be honest, most of the time. You're right. There'll be a day in here where it'll be ugly for me. The ARMR investing way. It won't work that day. But over a large body of evidence, it works. So we never execute our stop in the first 2 hours of the day. what we do is if we have a stop triggered in the first 2 hours, the low of that 2-hour period becomes the stop after 11:30. And we let that thing trade. And if at any point during the day after 11:30 it takes out that low of that top day, we're out. I'll give you an example. This just happened to us today. We were long shares of Guardian Health. The stop, I think the stop was 82 was our stop. Actually, I'm going to take you to a day trading chart that I use with an algorithm on it called the Price Movement Profiler that we built. Okay. So what you're seeing here are all the Fibonacci extensions above and below the opening range that we use. This black dotted line is the volume weighted average price. This blue line is the average true range low of the day. Here's the average true range high of the day. It's a dynamic range. It's an algorithm we've written that has to do with volatility. Okay? So what happened was this morning, you'll see at 11:30, we are definitely, well, we're below the stop earlier. 82 is up here. We broke below 82 in the morning. Sold off. Made a double bottom at 11:30. Notice how at 11:30 it reverses and tries to rally. Getting back above the stop right here at 1:30. Stock's trading at 82 and change, 82.44. Okay? So the stop hunt cleared out other people. We stay with it. It goes higher. Now it's above 82. Okay. When the asset took out the low of the 11:30 bar, which was right here on this bar, we already had orders in the system. We had stop losses in the system that took us out, bang, as it hit that price, which was a low right here of, I think it was 80 and change, 80.79, something like that. And it took us out, okay? So sometimes you're going to lose a little bit more than the 82 stop you wanted. It happens. I don't care. Because I stay in my successful trades longer if I do that. And every now and then, a Guardian Health takes you out of a position late and you lose an extra $1.25. Nothing compared to the amount of money you make when you stay in a trade that rips higher. Okay? All right. So those are the three. Oh, okay. Let's go take a look at Microsoft today. We added Microsoft, so I'm going to go over the stops and how do we come up with them. Okay, so we bought Microsoft today. You could use the low of today as your stop. That's the LODB. But if I'm being honest, and we all should be honest with ourselves, the real day where the move started was Friday. Okay, so we're buying 1 day late, theoretically. Friday was the day to own it. So the low of the day we bought is obvious, the day we bought it. The low of the move is the day before because that was the first up day coming out of this structure right here. Okay, you guys can see this kind of like a little pennant and it broke out of it on Friday. So in this case, I'm going to use the low of the move that we were buying. Since it's so close to the low of the day we bought, I'll give it a little bit more room. And if I was to use the low of the structure I'm buying, I would build a pennant. I would say this, something like this, just to give you an idea, and something like that. Okay? This is the low right in here of the structure that I'm buying. These lows, this low here and this low here. So that's the low of the structure I'm buying. The LOSB. Okay? Now, let me tell you something, guys. Ladies and gentlemen, this is a little bit more of an art than it is a science. You're going to see a different structure than I see. It's going to happen. It's okay. You become your own chart analyst. You look at where the structure is. That's your low of the structure. But this will be much more effective than using a blanket percentage for a stop, because the volatility is going to be different on all different assets. And I'll just share one other idea with you. I think you got the point. But let's take a look at, let's take a look at Southern Company. Maybe we could look at Dominion. We'll look at Dominion. Okay, this is a utility we bought I guess last week. Okay. The buy day really is right here. I think we actually paid for it on this day, which was the 27th. So on this day, we actually paid up for it, right? So the low of the day we bought is the day of the 27th. But you can easily see with your eye that the beginning of this move was actually on the 22nd. So that's the low of the move we're buying. And in this case, it's also the low of the structure we're buying, which is an uptrend. See this pennant right here? So if the price had taken out the low of this bar on the 22nd and closed below the low of the structure, that's a no-brainer stop loss on this position. You can use the low of the bar you bought, because look, the stock went straight up. It hasn't even challenged it. It's a fantastic stock, right? But the real stop for me would have been this one right back here, the low of the move, which happens to also equal the low of the structure. And this brings me to a point about position sizing. All right, so to wrap up principal protection stops, you have three: LODB, LOMB, LOSB. Okay, and you can use one or all three of them. You could sell a third, a third, a third at each price if you want to do it that way. Reduce your position a bit when it gets to each stop. That's fine. So if it takes you out of one stop, reverses and skyrockets, you still have a part of your position on. But you're managing your risk. All right, now let's get to position size before I move on to raise stop and profit protection. Position size is key. The closer we are to the stops, the bigger the position size is for the ARMR investing way. So again, a look here at Dominion. Had we actually bought it on the 22nd, you'd have your biggest position size on there. And honestly, it's okay to pay a little bit up for it. I'd still have my biggest position size on right in here, because I'm so close to the stop. Okay? How about, take a look at Southern Company, right? In fact, I think we bought this day on Southern Company. The 28th is the day we bought Southern Company. That was the day it broke the downtrend. You could have your biggest position size on right then. That is day one, right there. And then I think lower the structure and lower the move is back here on the 22nd. The 28th is the breakout. The 22nd is the low of the move and the low of the structure. You say to me, well, there's another low right here. But I say to you, when you're writing and building, and this is about technical analysis, and so if you're not well versed in this, you should get some books and read about it. But the idea about, I'll just share with you some technical analysis. Rule number one. In order to build a trend line, the best trend lines are lines that touch the most amount of price points. So if you have just one price point dangling in the air all by itself, you cut that off. And that's what we would do here with Southern Company. Okay? This price right here doesn't mean anything to me, because I'm drawing a line where this touches, another day, that day, another day, that day, da. You can see what I'm saying. That's where the line should be drawn. That's the low of the structure. Now, take a look at what we're doing today. Okay, we're buying shares of Kronos. Stock's up 20%, guys. Now, this happens to be the first day of the move. So this would be LODB and LOMB, which would be the low of today would be your stop. And if I was to say the low of the structure, I would have to take it down here, probably below this little structure right in here, probably the 50-day moving average, looks to me $6.16 versus the low of the day, which is $6.65. Now, guys, you're paying up 20%. Okay? Buying Southern Company and Dominion, you can have a huge position size on there because you're so tight to your stop. With Kronos, your stop's, way down there. So what you got to do is have a smaller position size to be able to manage the volatility. Okay? And that's, of course, what we've done so far. We've taken a 2/3 position. If the stock comes down tomorrow morning and gives us a chance to add to it a little bit cheaper, we will. If the stock skyrockets, we're done and we have a nice position size on. And we've managed our risk. Okay, very briefly now, we can wrap up. The raised stop status is the second type of stop that we use, raised stop. And what that means to me is when a stock after entry has gone up at least 5%, maybe 10%, that's going to depend on the type of asset. If it's a cannabis stock, it has to go up at least 10% because they rips, the moves are so huge. If it's a utility stock, it goes up 5%. You raise your stop to somewhere around break even. Could be plus or minus, depending on the type of person you want to be. I try to find a structure on the chart that looks reasonable to me, somewhere near my original entry point. But you want to raise your stop up once the stock has gone up 5 to 10%. And if it's small cap, illiquid name, maybe it has to go up 15%. I mean, the stocks that we're working with, the ARMR report, are liquid assets that that we can that typically don't move 20% a day like the cannabis stocks. So it's 5 to 10%. Once it's up that amount, you raise your stop somewhere around break even. I'll leave it up to you. If you're an ARMR insider, obviously I'll show you on the ARMR portfolio spreadsheet what the stops are. When I raise the stop, I'll tell you the price. Sometimes it's a 50-day moving average. Sometimes it's a hard price. And we do that because rule number one of investing, and there's always so many rule number ones, but a major rule of investing is that you don't want a gain to turn into a loss. That's the quickest way to start reducing your net worth, to have a gain turn into a loss. So at some point, you have to recognize the gain's enough to raise your stop to break even. And if you get taken out at break even, no harm, no foul to your principal. It's a principal protection stop. You gave up some gains, but your principal's intact and you live to fight another day. And the third stop I call the profit protection exit. Now this is very subjective, and I leave it up to you guys to determine the type of a profit protection exit you want to use. I basically use the 250 and 25-day moving averages, usually the exponential moving averages, every now and then the standard. The reason I leave it up to you is it depends on the type of investor you want to be. If you're a swing trader, you might use the 14-day moving average. Let's go take a look at Newmont Mining, just so you can understand this better. Okay, Newmont, first of all, let's see. One thing we like to do, and we'll use that, 4 standard deviations. So this line right here is 4 standard deviations above the 200-day moving average. So when you buy a stock down here at the 200-day, and it hits that 4 standard deviation line, and sometimes it's 5, sometimes it's 3. You have to work with it. You can use Bollinger Bands to do it. Okay, you can adjust the standard deviations on a Bollinger Band with the 200-day being your mean. You book some profits up here. That's just a targeted exit. Some percentage. But we're talking about profit protection exits now, or trailed stops. I'll use this moving average right here, which you can see is a 14-day moving average. I'll use the 25-day moving average, or I'll use the 50-day moving average. If you're a swing trader, if you're quick on the trigger and you want to book profits fast, you use the 14-day. You're out of Newmont right here on the 21st. Thanks for playing. Booked a huge profit. Okay? If you're a little bit more lenient, you give it to the 25 and you're out on this day, which is the 26th. Okay? If you're trying to invest long term, then you're holding this asset all the way through to here and you're booking some profits on that day. That's June 3rd. Okay? And I totally leave that up to you. I'm going to share with you what I'm doing, but you don't have to do what I do. We're different investors. Sometimes I'll use a fast moving average as the trail, and sometimes I use a slow. As they say on Wicked Tuna, one of my favorite shows, I'm going to put you on the meat. You guys are the anglers, and you figure out how to get it in the boat. And that, my friends, is a wrap for tonight. Those are the 3 stop rules we use in the ARMR investing way. The principal protection stop, LODB, LOMB, LOSB, the raise stop, and the profit protection stop. Any questions you guys have about stop losses, I'm willing to take some questions right now. Go for it. Okay, guys, I'm not going to go over charts right now about stocks that you're asking me. And we can do that on another day. Okay, I'll certainly do it over the weekend. On Saturday, I'll go over those things for you, no doubt. And if you have any comments or questions, if you didn't watch this video live and you want me to look at a stock and address it on Saturday, just leave it in the comment section so that I can remember and go back and look at it. And I'll discuss that with you guys on Saturday. But today, I just wanted to focus on the stop loss rules. If you have any questions, if not, God, I'm ready to wrap it up because I'm tired. It's been a long day. Okay? I'll give you another couple seconds here. Anything about stop losses, or are you guys all good? All right. It looks like you're good. I appreciate your time with me. I look forward to seeing you guys again tomorrow in the Slack room, all of my insiders. And YouTube subscribers, I'll probably be out there again on Wednesday chatting with you about something. All right? Have a good night, guys.